Hello, this is Eric Parnell, Chief Market Strategist from Great Valley Advisor Group, and I'm joined once again by Evan Coffey, Investment Analyst from GVA. What are we going to talk about today, Evan?
Well, Eric, it's great to be here with you on Market Insights to start 2026, and we have no shortage of topics to cover as the year gets underway. It feels like what's captivated financial and world headlines is truly geopolitics. So that's kind of where I want to start today. Between Venezuela, Greenland, and now more tariff talks, there's a lot to focus on from a lot of different angles. So to start with Venezuela, on January 3rd, the United States carried out Operation Absolute Resolve, which entailed military strikes in and around Caracas and ultimately the extradition of President Nicolas Maduro and his wife. Currently, they're in U.S. custody, being held in New York City and facing narco-terrorism and drug trafficking charges. President Trump and the administration, since the operation, have worked with interim president of Venezuela, Delcy Rodriguez, and President Trump has made it clear that the United States would be heavily involved in running Venezuela. He also wants to take advantage of the country's proven oil reserves and to this point met with U.S. oil executives over the last few weeks to discuss their investment into what's really a dilapidated oil infrastructure in terms of Venezuela. So what has this meant for markets? Well, not really a whole lot. We saw the initial reaction for Brent crude. It dropped, but it's since risen above those pre-incursion levels. As for the major U.S. drillers and refiners, that's probably where we saw the most visceral reaction. Chevron up more than 9% since the operation. They're the biggest beneficiary. But Exxon and Conoco following up about 8 and 5% respectively. Outside of these names, the reaction has been fairly muted and ephemeral. I don't think that we're going to see too much more from this for the time being, but what we have seen is now a greater focus on geopolitics in headlines. We've seen a lot of talks about Greenland. We saw the potential for the U.S. to get involved in Iran due to mass political protests. So what I want to first ask you today is this cause for concern for financial markets? Typically, they seem to roll over geopolitical news, but this feels like it's spiderwebbing out a little bit more. Just over the weekend, we got additional news that due to the EU's involvement in Greenland and their opposition to the United States acquisition of the country, President Trump said that he would establish an additional tariff on France, Germany, the UK, and others. So do we need to be mindful of geopolitics and tariffs like we were in 2025, or do you think that this is different from that February to April period last year?
No, these are great questions, and this is something that investors should continue to be conditioned to as we go through the next 3 years. The way to think about the Trump administration is kind of like the anti-Teddy Roosevelt. Talk loudly and carry a foam bat. That doesn't mean that stuff isn't going to happen. It doesn't mean that stuff is going to matter. We're going to see a lot of noise, and we're going to see a lot of things said, and they're all part of the negotiation. They're all part of the tactics, and it all kind of makes sense in terms of the way that we've seen the administration work over its first term, over its second term, and the way the president operated during his business career. There's a lot of things that get said that need to be taken with a huge block of salt because they're part of the negotiation. So the way we should move forward as we go into 2026 and beyond, expect continued market volatility associated with these types of things being said. And it leads to some things happening. We saw it with Venezuela. There's an end game that's being driven towards, but there's a lot of things that are said along the way that can rattle markets because investors really aren't used to this type of thing. I mean, they're more used to it than they used to be. But investors, if anything, should look at these periods of volatility as buying opportunities. As the market adjusts, as the market reacts, as the market absorbs, these types of events and their implications. We've seen it time and time again. There's a short-term pullback, but if anything, that serves as a buying opportunity. And it brings us to a broader point. The markets are likely to get more used to these types of things as we go through the next 3 years. Things being said that may or may not come to fruition. At the end of the day, there's two things that matter to the markets more than anything else. Basically, the economic fundamentals, which continue to remain strong, and liquidity. Is sufficient liquidity on net coming into the marketplace in order to drive asset prices higher? And the answer to that question right now is yes.
Yeah, and I think that I would certainly second that. And that we saw again, it had a more substantial reaction last year, especially in April. But we moved out of that pretty quickly, and then we had a strong period of time up until about November where we saw very little volatility. So another headline, moving to my second point, and potential market mover, especially for major equity indices, is Q4 earnings. Mm-hmm. We've rolled into earnings season with big banks kicking things off last week. FactSet is projecting 8.3% EPS growth for the S&P 500 in Q4. This will be the 10th consecutive quarter of earnings growth for the index. We got a mixed bag of results last week. JP Morgan missed, but this was largely due to their one-time charge associated with their acquisition of the Apple credit card business. Morgan Stanley, Goldman beat on both top and bottom lines, and Taiwan Semi, really the biggest tech company to report thus far, crushed it on earnings, showing double-digit revenue growth, and they raised their capex for 2026. Looking ahead more broadly, 8 of the 11 S&P sectors are anticipated to post year-over-year gains, with Infotech, no surprise, leading the way at 25.9%. Overall, 2025 EPS growth is expected to come in at 12.4% for 2025, and for 2026, that is anticipated to improve to 14.9%. So, what sounds like a great backdrop. My question to you is, what do we need to watch in terms of Q4 earnings as we roll into the Mag 7, some of the bigger tech names? And then what do we need to be on the lookout for in 2026 in terms of earnings?
No, it's a great question because, again, and building off that point in terms of what's important to markets, economic fundamentals, which drive corporate earnings growth, which are the primary determinants of stock market returns. If the economy is growing, that's good for corporate earnings to rise. And if corporate earnings are rising, we'll see higher stock prices, all else equal, more often than not. So that's the environment that we're operating in right now. One of the things that we've seen over the last 4 years, since 2022, in the bear market that took place that year, we have seen consistently strong earnings growth, and that's been driven by an economy that has been persistently growing despite all of the concerns about that economic slowdown that never materializes. And as we look ahead to 2026, once again, we have forecasts for double-digit earnings growth over the calendar year of 2026. If those earnings expectations hold as they have over the last few years, we have good reason to think that we'll continue to see a rise in stock prices as we go through 2026.
Well, I think then this is a good segue into my last point. You mentioned economic fundamentals. Let's talk about the macro backdrop. Mm-hmm. Starting with the labor market, the unemployment rate did move lower in December from 4.6 to 4.4%, but the 3-month average change in payrolls was a mere 22,000. We started 2025 and this was 232,000. So clearly we're seeing less job growth in the United States. Unemployment rate still, reasonably close to 4%. In terms of the other side of the Fed's dual mandate, we got a CPI report last week. It was much of the same as November. Headline was at 2.7%, core at 2.6%. So I feel like we kind of got a stagnant both labor and inflation report for December. Where do you feel like we're at in terms of the Fed's dual mandate, and what is your expectation in terms of this easing cycle in 2026?
Yeah, so it's been an interesting market environment and an interesting economy we've been operating in over the last few years because we've seen consistent growth and we've seen strong earnings growth, but it's been very concentrated. You hear so much about market concentration and the Mag 7 and how technology has been driving the market. Well, there's been a reason for that because that's where most of the growth has been taking place. If you take out the technology sector and you look at the rest and communication services and a couple spots of consumer discretionary, the earnings performance of the market and the economic growth in many of these other sectors has been pretty lackluster. If anything, the performance in technology has overshadowed what has been, arguably a recession in a lot of these other areas of the market. So that leaves us in a tricky spot. We have seen employment growth slow. Companies stopped hiring, and now they're starting to cut back in certain areas. We want to keep a close eye on that in 2026, because if we continue to see further labor market weakening, that's going to be tough for the economy. But if inflation expectations and current inflation readings remain in check, I would argue that's a good thing not only for the economy, but it's also a good thing for financial markets. Because if the Federal Reserve maintains the flexibility to lower interest rates, and they've already been lowering interest rates going all the way back to 2024, if they continue to cut interest rates, we got 15 years of market history to show that stocks love that. And the bond market can like that too. So that's good for investors. So that brings us to that number one downside risk for financial markets. The futures markets are currently pricing in the probability for 2 interest rate cuts from the Federal Reserve between now and the end of calendar year 2026. That's good for markets, particularly in an environment where we're expecting double-digit earnings growth. I mean, that sets up for a really good year for stocks. However, one of the primary risks is this renewed rise in inflation. It's been slowly creeping up. The primary thing that had caused inflation to move lower since 2022 was goods deflation. The price for durable goods and non-durable goods had been falling all the way through the last 18 months or so. Well, in recent months, that's been starting to rise. If we continue to see a rise in goods inflation, in durable goods, non-durable goods, the things that, automobiles and dishwashers and things like that, if that continues to rise into 2026 and it starts to push those headline and core inflation numbers higher, it's going to be a lot harder for the Federal Reserve to cut interest rates. And then we could run into a situation where the Federal Reserve is not adding liquidity, but they need to start draining liquidity to fight the inflation problem. We run into that, and markets aren't going to like that very much.
Yeah, well, I think we've answered a lot of good questions today. I think that this is a great start to Market Insights for 2026, and it was great to talk with you.
It's always great talking with you, Evan, and thanks for joining us for our first Market Insight for 2026. We look forward to another good year talking about the markets and the economy. We look forward to seeing you again soon.